You're about to hear my conversation with our chief fixed income strategist, Dustin Reed. We covered a lot of ground today, talking about the Fed, tariffs, Canadian politics, Bank of Canada, as well as the generational change in Germany. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. I'm your host, Matthew Schnurr, and I'm back with my regular guest, Dustin Reed. Dustin, welcome back.
Hey, Matt. Thanks very much for having me back on the podcast.
Why don't we get started? We schedule these podcasts to correspond with the Fed decision days. So why don't we get started with your take on what happened yesterday and what you're looking at?
Sure. Yeah, absolutely. So Fed decision yesterday, of course, the March meeting, which is a forecast meeting. Fed obviously holding rates unchanged, as was very, very broadly expected. A lot of interest going into this meeting around how the Fed would interpret some of the recent quote unquote softer economic data out of the US and what it would say. And obviously, given that it's a forecast meeting, as always, what is the Fed thinking about the dot plot, and some of the other forecasts. So the statement, which is obviously the most formal part of the Fed meeting, was particularly interesting. There was some significant language change. Again, and maybe it's a bit more mark to market in a way, where the Fed moved from the comments in the January statement from having a relatively balanced outlook to an outlook of one of more of uncertainty, and so that uncertainty kind of narrative, I would say carried throughout the rest of the event yesterday, whether it was the press conference Q&A, the prepared remarks for the press conference, and the projected materials, the SEP, the dot plot, etc. itself. In the dot plot, I thought what was particularly interesting was that there was no change to the median dot for 2025. And there was really not a lot of changes to the median dot in the out years nor the long run rate, still at 3%. But the central tendency, kind of like the balance of risks or the skew, did get a little bit more hawkish for 2025. So there are now 8 participants out of about 19 that are looking for either no cuts or one cut for the rest of 2025. And that number was 4 at the last forecast meeting in December. So we've gone from 4 participants looking for 0 or 1 to 8. So, i.e., maybe a little bit less cuts this year, although the median dot is still suggesting that there will be 2, presumably 2 by 25. So that's interesting to me. The market did not particularly focus on that. The market was a little bit more focused, particularly the rates market. I would say the equities market yesterday, the day of the FOMC meeting, was a little more focused, I think, on the idea that the Fed is around downside growth risks. And what is that? And what does that mean? And you had a bit of a it's a little aggressive, but stagflationary tendencies in some of the other projected materials. So, for example, core PCE, which is the Fed's preferred inflation measure, is now expected to be, I believe, 2.8% by the end of the year, up from 2.5. So that's a decent clip higher from on a 3-month period from December to March for the projections. You don't usually see quite that much. And then on the growth side, real GDP for this year was moved lower by about 0.4, I think, from about 2.1 to 2.1 to 1.7. So you have lower growth and higher inflation. So it's not stagflation, because clearly you have growth and inflation is not massive,
Right.
but those are kind of stagflationary tendencies. The interesting thing, and we've talked about this on a few podcasts, I think it's important to reiterate it. I mean, I'm sure we'll talk about tariffs during this podcast, but how do central banks view tariffs? Is that a concern from an inflation perspective and rates need to stay on hold or go higher? or is it or is it an economic shock, negative economic shock, and do rates need to move lower? And not everybody sees it the same way. So on the inflation side, the move higher in core PCE, or at least the estimate, from 2.5 to 2.8, there were no changes for the what we call the out years. So for 2026 and for 2027 in the inflation estimate, the core PCE estimate, those
Got it.
estimates remain the same in March as they did 3 months ago in December. So that seems to suggest that some at the Fed, or at least the balance at the Fed, believe that any upside risk to inflation is somewhat temporary. Although that kind of goes against what I said a few minutes ago with this idea of the central tendency, and more people are looking for uh, uh, less cuts than they were 3 months ago. That 0 or 1 cut in 2025. So there's something interesting going on when you really peel back the layers, and I think the market is probably going to have a little bit of a tough time, like literally peeling apart what the Fed is thinking. I mean, and in the press conference, and maybe I'll finish off with this. Like the formal statement said, we've kind of moved from an outlook of balanced risk to uncertainty. Powell basically said as much. We've seen so-called soft data really capitulate here over the last 3, 4, 5 weeks, particularly the survey data and the regional survey data from around the country. But it hasn't particularly translated yet into what we would call the hard data, the kind of the big data prints that we all look at and watch. And the Fed is admitting that it's not completely sure if it is going to follow through from the soft data to the hard data. They are kind of waiting for confirmation. Of course, the market will probably not wait for total confirmation. And so here runs the risk where it could be seen that the Fed is quote unquote behind the curve if the activity data or the prices data moves significantly in either direction. And I think the Fed is trying to say, without coming out overtly, that we are a little bit unsure, and we are a little bit surprised that we have not seen the hard data reflect as much downside risk, particularly on the growth side, as the soft data. So that was kind of my takeaway from the press conference yesterday. So I thought it was a lot of interesting things, even though kind of at the surface, not a ton happening, but when you kind of paddle under the surface, there's a lot. I think there's a lot going on.
Great context, and I'll say that you can forgive the Fed for not knowing exactly what to think about tariffs. And I don't know exactly what to think about tariffs as well, Dustin. So I'm hoping that we can start the tariff conversation by just level setting and talk to me about what tariffs are in place today on March 20th, which ones are supposedly coming, barring some sort of change in position from the White House, and which ones have been threatened.
Okay, well, this is the whole podcast if we want to do it,
Sure.
but I'll try and do the semi-executive summary.
Yeah.
So obviously, steel and aluminum tariffs are happening on Canadian exported goods into the U.S. or imported goods into the U.S. So that's on. Canada has retaliated, not one for one, but has retaliated on a number of things, and it's set to do so again in a week or two time. But even with that, I believe it would not be a one for one.
Uh-huh.
U.S. has put additional tariffs on Chinese exports to the U.S. or imports into the U.S. Or you want to say it. So that's happening. And those are kind of the big ones, I think, at this point. What I'm expecting, and generally long expected, although I've tweaked the view a little bit, but generally since early this year, I would say January, before the big kind of early February back and forth.
Right.
The April date was always significant to me, particularly after Trump came in and signed the executive order for the agencies to basically take a look at everything and come back and tell us how tariffs would impact you. And that April 1st, April 2nd, now I think date I think still looms large. The original view was April 1st, 10% universal tariffs across the board. The whole discussion we've had around ERS as a real thing and the government wants to structurally change how it brings in money from outside, less from the U.S. taxpayer, however you want to define the U.S. taxpayer, and more from the foreign taxpayer, however you want to define the foreign taxpayer, whether that's personal or corporate. I think that has morphed a little bit, not entirely. So small, maybe April 1st to April 2nd. Okay, no big deal. Um, and it seems to be a little bit more reciprocal tariffs, although there still is a universal tariff undertone to that. And what I mean by that is actually the timing of our podcast is pretty good as it happens. So earlier this week, Secretary Bessent was on I think Fox early before market open and said a number of interesting things. He basically said that on April 2nd, and keep in mind this is inside 2 weeks from here, on April 2nd, every country will get a number. Every country will get a tariff number. He also said something to the effect of the U.S. imports goods from predominantly 15% of countries, and those 15% of countries will be where the bulk of the tariffs are acted. So I thought that was interesting. There were a number of other things too. So the first comment that I just mentioned has a bit of a universal tariff undertone to it, right? Like every country
Sure.
gets a number, but I think a bunch of countries could be a zero. I mean, so is that a number? Is it not? But I mean, everyone gets assigned something, and I think that could be anywhere from zero to who knows what, right? But call it 0 to 25 for kind of a reasonable range, and then maybe there could be some stuff beyond that. I think that is happening. I think it would be odd for the Treasury Secretary to be saying that out loud on TV 2 weeks ahead of time if something around that was not happening. So that has been our working assumption for a while, and of course we're tweaking it as we get some of the news flow. But the idea of something and something maybe considerable happening, it looks like now April 2nd, but originally April 1st, not a big deal really. Which day of the week it is, but it seems to suggest that that is happening now. I mean, there's roughly 200 countries in the world, so 15%. I mean, not rocket science, is about 30 countries. I would say Canada is probably going to be included in those 30 countries.
Sure.
So I am a little concerned around what might be happening here around the April 2nd date. It could be significant. And then of course the question then becomes, well, there are many questions, I guess, but how big,
Sure.
on what, and of course, is Canada going to retaliate like for like, dollar for dollar, or are they going to do something else? I mean, I've even heard of the idea of Canada putting export taxes on the goods that the US is putting import taxes on, to make those goods even more expensive and penalize US consumers even more, with the idea that it would just cause US consumers to get very, very upset, make a big deal about it,
Right.
complain to Congress people, and try and go that route. Right? So maybe, as opposed to just, okay, well, $100 billion in tariffs on you. Okay, well, we're going to put $100 billion of tariffs on you, and it's like one for one or what have you. And some people thinking that that actually might not be the best strategy. So I think the reciprocal tariff story is, and when I say reciprocal tariffs, I'm not saying U.S. reciprocal tariffs on, say, Europe, because they have a VAT, value-added tax, and U.S. doesn't. I'm saying reciprocal tariffs because U.S. tariffed us, so we are going to
Right.
tariff you back. So that's where I think things are at. And I mean, we'll know soon enough, and then it gets very complicated, I think, because back to Beston's comments, if every country gets a number, then like, how do you deal with it? What is it on? How do these countries react from a reciprocal perspective? How do the respective countries' central banks also react?
Right.
Some of them will see it as an inflation shock, and not a one-off price level higher, which is, again, has been generally our view here of how I think the Fed and the Bank of Canada will look at things. But not everybody will see it that way, or will it be seen more as a negative demand shock. And so every country is different. I mean, I'm sure there'll be some overlap, but I mean, with 200 countries, I'm sure there'll be something. But
Sure.
generally speaking, I've been asked these questions. So, what does it mean for rest of world? And I think that is a very, very broad brush, and you almost have to go. You almost have to go case by case, particularly for, if true, the 15% of countries, call it 25 or 30 countries, and where the big tariffs potentially are going to occur. So you kind of have to go down the list and say, like, what do how are these countries, both from a government perspective, going to react, and how do the central banks of those respective countries also think from an orthodoxy perspective? So it gets tricky, and I think I'll be busy for a good chunk of the second quarter because of that.
It sounds like it. Um, I I guess just to be specific on Canada, and your expectations for April 2nd, sounds like you're pretty confident tariffs are coming in some form. Do you have a sense if it's going to be general, and is a 25% number likely, or you expect it to come in somewhat?
It's a great question. I don't have a great edge on it because I don't think it's been decided even within the administration. I think they're still figuring out uh, the numbers on different countries and if they are going to be slightly different, even within countries, even if they assign a number, quote unquote. For the great Canadian example is, and I'll slightly make up numbers here, but 25% on everything but 10% on oil and gas, or 10% on everything and actually will exempt oil and gas
Right.
imports, and something like that. We get the majority of our goods from 15% of countries globally. Comment earlier this week has got me a little bit more concerned about maybe it's not going to be a 10% number on Canada, and it could be higher. That does have me concerned. So I'm kind of thinking 10, 15 here. I think 25 is probably a bridge too far. I think there's been enough media and enough pushback from kind of the commerce level, commerce industry level CEOs, particularly in the auto side,
Right.
that have probably given the administration enough feedback that at least Trump is probably getting some earful that some of this is not a great idea for the economy. But Trump, has gone out and said we don't need Canadian cars and we don't need a whole bunch of stuff that Canada makes or really anything Canada makes. And I'm not saying that that's true or not true. I guess I'm saying it's probably not true, but
Sure.
but
Seems like an easy one.
yeah, I guess. But that is his opinion, and it is very tough to tell if people like Commerce Secretary Lutnick or Treasury Secretary Bessent or U.S. Trade Representative Greer can really change Trump's mind. And obviously, there are a significant number of people that are listening to this podcast in real time that would probably be thinking in their head right now, no, like Trump is not going to have his mind changed. And so that's where it's very, very difficult to get an edge on
Sure.
these sorts of things. So, but that's kind of what I'm thinking here for now. Kind of stepping back a little bit. I will be a little surprised if Canada escapes April 2nd without any tariffs. That does
Sure.
not seem to be the direction of travel here. The direction of travel seems to be the other way, and now it's a question of magnitude.
Good. And length, I should add too.
That's very fair. Like this for 30 days is one thing. This
Yeah,
for
right.
a year more is obviously quite another, and that's a very, very good point.
And do you feel like you have an edge on length at all, or that's sort of the same as your previous comments?
So I really do believe that not only Trump, but a lot of people in the administration want to structurally reform how revenues are collected by the federal government. And that leads me to believe, or at least skew towards the idea that some of these tariffs could be on for a prolonged period of time, more than a month, let's say. Like
Sure.
this is something for quarters, a year, maybe longer, maybe longer. Obviously, USMCA looms in the background and the renegotiation of that treaty, for 2026. Uh, I mean, if I'm Trump, and obviously I sit here in Toronto, I'm Canadian, although I've lived in the States 14 years. But if I'm Trump and I'm looking at that USMCA, I mean, why would you not have something on Canada from a tariff perspective that's relatively challenging as a negotiating point ahead of the real negotiating for USMCA? I mean, it seems like that would be somewhat from the art of the deal Trump playbook. That would seem kind
Right.
of the obvious way forward. So we're sitting here in March. That's going to be in April. USMCA comes up next year. That's 9 months. I guess my base would probably be quarters at this point. Upside surprise is it's months, and downside surprise would be years.
Great context. We've talked a lot about tariffs and specifically impact on Canada potentially.
Yeah.
Two other things in Canada. Most recently, we had a Bank of Canada meeting where we got the widely expected 25 basis point cut, as well as Carney securing the Liberal leadership and Prime Minister.
Yep.
And rumors, seems like pretty credible rumors of election in late April. Put that all in context on what that means for Canadian economy and possible, trade negotiation or however you think that that's impactful.
Yeah, for sure. I mean, we could do another hour on that one
I'm
too.
sure.
So maybe the bank quick cut by 25. That was actually interesting in and of itself. There were I'm trying to get my dates right here, but in February when we got the January CPI print, it came in pretty hot.
Right.
And you saw market pricing for the March meeting, the Bank of Canada meeting we just had, fall away pretty quickly, down to maybe 6, 7 ish basis points, 8 basis points, something like that. So definitely not a zero, but well below 50-50.
Right.
And a number of the banks capitulated on their view, thinking that March would actually not happen. March would not get a cut. And we actually kept the view that the bank would cut on the notion that the bank would be a little bit more focused on the risks of tariffs and downside risks to the economy as the big driver, as opposed to inflation, particularly inflation early in the year in January, which has over the last few years been a bit whippy. And tough to actually think if that's at the beginning of a trend or not. So we actually held fast, and then the market fell away, and then kind of came back. I think we were around 20-ish basis points price, so kind of 80% going into the meeting after being probably around 30 or 35 at some point after the CPI data, the Jan CPI data that printed in February. So that worked out, which was good. I think the bank, and maybe just to kind of rewinding it, just kind of set the stage here. So the bank now with the 25 basis points is 2 2 3/4 the bank's administered policy rate, and 2 3/4 275 is the midpoint of the bank's current neutral range of 2 1/4 to 3 1/4. And my view for a long time has been that given the risks ahead of us domestically here in Canada, for all the obvious things of which we've talked about already,
Right.
is that the bank would probably want to be in the bottom half, maybe even closer to the bottom of what it considers to be the neutral range of interest for the economy, where rates are not accommodative nor restrictive. So that would be somewhere between 2 1/4 and 275. Every April, the bank, well, before every April, but leading up to the April meeting, and the April meeting in Canada for the Bank of Canada is a forecast meeting. So, leading up to the April meeting, the bank goes through the exercise of what is the appropriate neutral rate of interest for the Bank of Canada for the country, just like R star for the Fed for the U.S. That's the
Right.
same. It's the same discussion, but for here. And a big input into R star for here, the neutral rate, is actually what's happening in the US. Go figure. And R star, as we know, over the last year has moved up somewhat significantly by, I think, a couple of notches anyway. So it's currently sitting at 3%. So I think there's a pretty good chance that at the April meeting, the next Bank of Canada meeting, that they're going to up their neutral rate again from 2 1/4, 3 1/4 to 2.5, 3.5. I'm going through this whole exercise to basically say, okay, where are we? Okay, so we are now at 275 in terms of the official rate. Okay, So if the bottom end or the whole range really, but the bottom end of the neutral range comes up by another quarter point from 2.25 to 2.5, and you're sitting at 275, how much more for this part of the cycle is the bank willing to ease? And I think we're pretty close here. So I think it will move higher, the neutral range. And so I think we're either going to perch, which is the term I've been using, just kind of waiting and seeing, either at 275 or at the new bottom end of that range, which is 2.5. Now, if I'm right on tariffs and it's kind of a lot more than 10% and it's ugly and it's obviously a negative growth shock that's going to happen to the economy, we
Sure.
will move below what the bank perceives as the bottom end of neutral because it wants to be in what it thinks is the accommodative uh, area for interest rates in the country. So we'll be looking at 2% or something with a one handle, maybe 1.5, or it depends on the severity. So that's what I think is about to happen for the bank. And so these tariff announcements, I mean, obviously they're very significant on many levels, and the bank's watching it too. Um, but I think what the market's missing a little bit on Canada is that they're forgetting that the discussion around neutral is around the corner, and that there's a pretty good risk that it could move higher. And if the bank's being uh, kind of diligent with its own models, then it does have an impact on maybe near term easing rates, unless again something very, as we would say, like left tail, like bad news comes out on the tariff side. On Carney, politics aside, I mean, I think Carney's obviously exceptionally well versed on so many things. Having run the Bank of Canada, having run Bank of England, having done obviously lower level jobs at the Bank of Canada, not just governor, having been seconded to finance. It's obviously done a lot in the private sector. Obviously, very heavy on the climate side. Actually, when I was at the Bank of Canada on the foreign reserves team, the bank, as all central banks do, basically they own foreign reserves, rainy day fund, if to intervene in the currency or the bond market or other, and but in Canada that money is not. Even though the Bank of Canada manages it, it's actually managed in trust for the Ministry of Finance. It's government money. It's not the Bank of Canada's money. And so you had a dotted line when you worked at foreign reserves in Bank of Canada to somebody in Ministry of Finance. And when I was there, it was actually Mr. Carney. So he was kind of overseeing it as assistant deputy finance minister at the time. And I think he's obviously done very, very well in the polls. I think that a lot of people in the country think that he is best placed to deal with whatever ends up coming up and from a tariff perspective with Trump south of the border. Um, and I think a lot of people have, rightly or wrongly, have associated Bolivar with kind of Trumpian type
Right.
policies, and people are so frustrated with what's happened, given the long-standing relationship between the two countries since early February, that it is obviously happening, or it's obviously happening in terms of Bolivar's approval levels. So it is a horse race, whether it's conservative majority or minority or liberal majority or minority. I mean, it's all pretty close at this point. All of those are somewhere between kind of 20 and 40 percentage points, and I think it's a real horse race here to the end. If it is in fact, as the Globe stated or scooped this morning, if it's going to be an April 28th election. We had been looking since January for the following weeks, either the Monday, I think the 5th of May, or the 12th. So might get it a week earlier than we had thought back in January, but that's not bad. And a lot of our trades and ideas and options ideas have been kind of structured around that timeline. So it's
Got it.
it's. I mean, we'll see if it happens, but not necessarily a big miss from that perspective. I think the debates will be very, very interesting. Maybe some of the best debates the country has seen in a while between Carney and Bolivar. I think it'll be really quite interesting to see policy differences, people that are quite articulate around fiscal and monetary and economics, and obviously have very, very different views on climate. And I mean, again, depending on the tariffs, And if it's really ugly, and if there needs to be a fiscal package, what does that fiscal package look like under, kind of the big four scenarios? Again, kind of a conservative majority or minority, or liberal majority or minority. One thing that listeners probably know, but it's worth flagging, is at least the last I saw in a lot of the federal ridings, the Liberals do not yet have a candidate to field. So that's obviously important. It'll probably be a question of momentum, Liberals versus organization, and to a slightly lesser extent, money, because the Conservatives, I think, have a pretty good backstop. So it'll come down to that, and yeah, I think it's going to be a very, very, if it is indeed the 28th. I mean, we're in for a very interesting 6 weeks here.
Great comments. I want to quickly touch on Germany
Sure.
and Europe as a whole. Fairly significant shift in fiscal policy out of Germany.
Yeah.
Pretty big impact on their fixed income markets and rate markets. Just give me your high level comments on that and what it can mean for Europe and I guess the rest of the world too.
So what has happened in Europe in the last 2 weeks, 2.5 weeks, is, and not to sound dramatic, but if I said it was a generational event, it might actually even be an understatement.
Yes.
The German side has moved in a way that I have not seen in my career, and I think most people, really, even in the business for even longer than I have not. This has been brewing for a while. I think maybe it'll sound odd, but I think the Zelensky Trump meltdown
Right.
in the Oval Office a few weeks ago was what really lit the match. And I think not everyone, probably not good to speak in absolutes, but I think a lot of people in Europe, continental Europe, looked at that and said, and around the world, but in Europe, looked at that and said, "Oh, wow! Like this is a game changer event. We cannot, we cannot, at least for a while, rely on the U.S. to back us up,
Right.
and we need to do more in terms of our own defense and military strategy." And it really shocked the system. I can't underscore how significant not only that event, but all the other events that were around that, and moved in the same direction, really impacted thinking in political Europe, continental Europe, the UK to a point as well, but particularly continental Europe. And so much so that the Germans, who have this famous kind of debt break
Yes.
that doesn't let them go into significant deficit, basically have now suspended their debt break for the first time in I couldn't tell you how long. Um, this pandemic stuff, a kind of outside pandemic, but
Sure.
first time in a very, very long time, saying that we need to spend significantly not only on military spending, but also on infrastructure. And so the Germans are going to spend €1 trillion, with potentially more to come in the coming. To be fair, it's probably over the next 10 or 12 years. But it's a significant number, and they will blow through their so-called debt break. And they did it, and there was a German election not too long ago, and they basically did it and rushed it through the lower house and got it done before the constitution of the new house took place. And that was also very significant and somewhat controversial, with a couple of challenges getting brought to effectively the German Supreme Court, the German Constitutional Court, because they were concerned that once the new parliament sat, it would not have the two-thirds majority to be able to change the constitution to actually go over and override the debt break. So these are very significant things. This is significant if it happened over 6 months or a year. For it
Right.
to happen over 2 or 3 weeks is, again, not to sound overly dramatic, but uh, like that is a generational event. That these things do not typically happen. There's also spending happening on kind of the European side. Should there be a European army? Where should we be spending our should we be spending more money on defense, and we can't necessarily be reliant on U.S. defense contractors, so we need to be spending more in Europe. As an aside, Sweden has some defense contractors. After this all happened a few weeks ago, you saw a huge
Yeah.
appreciation in the Swedish currency against many other currencies in the world because people thought, okay, well, here are established defense firms in Sweden, so these are where the inflows are going to go. So here we go. So that's kind of how you see markets in a way trading. We saw a huge move in German bunds, which are of course the benchmark for European fixed income. Move from kind of the mid twos on the 10-year to around 290, a little over 290, almost overnight, within maybe 48 hours. A very significant move on the idea that because of this huge fiscal package, German growth now on a medium or long term run rate needs to be recalibrated. So while I think a lot of people might have been plugging in German growth at I don't know, 0.2, zero point 0.3, 0.4, zero point 0.5 on a long term run rate, now you probably add half a percentage point to that.
Right.
And then there's also maybe some upside inflationary risks as well. So when you were kind of looking at a 2.5 run rate for nominal GDP, now you could be looking at 3 or 3.5%. So some people actually still think that even at 290 10-year German bond yields, that those are still low, and they should be more like 3.25, 3.5. So it's been it's been quite profound. It'll be interesting to see. So France, which is obviously the number two economy in Europe, has had a lot of issues politically. Macron's barely
Sure.
hanging on. There's no room in that budget. They'll probably have the government fall. Macron can't call an election anyway until at least June. So, will other European countries or can other European countries step up on the fiscal side as much as Germany is the question. So far, it's kind of been a no or not really. But if that changes, then the trillion euro, which is really just the German number, is going to be larger. There's also some discussion just from an economics perspective. What's the multiplier? Is that multiplier on that trillion? Is it 0.3 or is it more like 0.8? Because that makes a difference
Of course.
in terms of the overall spend and the money, the money supply in the economy. And obviously, at the end of the day, the central bank will have to act and all those things. So it's a very interesting time, and we've gone from just rewind like 6 months ago, Trump, or at least before Trump, like spend, 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 U.S. Like let's juice nominal GDP in the U.S. Europe is a low beta economy. It looks really sluggish. To Europe, spend, 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 and US Doge, and let's cut things, and let's actually maybe create a little bit of pain in a recession, and
Right.
let's cut some of the fat out of the federal government, and market corrections are healthy. I mean, what a change over the last 6 months. And this is why macro is extremely interesting and extremely important and a very important driver for markets.
Great context, Dustin. Just before we leave the conversation, give us some idea on what you're doing in the portfolio and how you're expressing some of these views.
So we've had a couple of trades on, maybe more than a couple of trades to be fair, but the big trade we have on, I think, in the macro space, particularly North America, is this spread trade at the long end for some of the funds and for 10 years at some of the funds, and that's basically looking for what we would call a spread narrowing between U.S. rates, U.S. yields, and Canadian yields. The example would be kind of 30-year yields between U.S. and Canada a couple months ago or maybe 6 weeks ago, were about maybe negative 155. So U.S. 30-year yields were 155 basis points higher than Canada. And we thought, while we don't necessarily disagree with the negative sign, the
Right.
magnitude of it was too big. U.S. growth slowdown, maybe the market getting a little bit too pessimistic on the Canada side. We could see some spread narrowing a little bit more on probably the U.S. side versus the Canada side, given the tariff story and the concern. So it's a little bit more on the U.S. side than Canada, but playing it from a spread perspective. So we've seen that spread move from minus 155 to above, I guess, since it's a negative number, above 130. And I kind of had an original target of around 110 before we reassessed and saw what the drivers were like. So we've had that on in some size, not massive size, but decent size in a number of the portfolios: global, unconstrained, core plus, and that's worked out okay. Direction's been right, and the move's been in our favor. So that's been the big kind of macro trade, I would say, on the North American side. We hit our target. We had some TIPS holdings, so Treasury
Right.
U.S. Treasury inflation protected securities. We had a decent amount of duration in real duration TIPS for a while, and we hit our profit level there and took some of that off. But I would say, if the inflation picture, particularly the goods inflation picture, starts to move higher again, we could re-enter that trade. We were being disciplined with our stop loss, take profit level on that, and hit 240 in 30-year in the 30 years, and on the tip side, and decided that that was the time to at least take some risk off of the table. We also we are trying to pick up a little bit of extra duration on the New Zealand side, although that picture or that story probably doesn't look as solid now as it does maybe when we talked about it 3-4 weeks ago, just in terms of some economic data domestically in New Zealand that's come out. But New Zealand, Canada, similar open market economies, floating currency, somewhat commodity heavy. The tariff story is probably a bit different, to be fair, but the yield capture on tens in New Zealand and versus here is significantly more, and the currency hedge was relatively inexpensive, so we could fully hedge the position. It really didn't cost us a lot in terms of overall yield. So that's been another one where we've tried to get a little bit more pickup. We have very little on the emerging markets side at this point. We have some Indonesia, but we've dumped a lot of other things, including Brazil, Mex, South Africa, with some of the volatility. But from a more longer term structural question, one of the questions I'm always asking myself is carry a thematic, and what is volatility doing? And I think we could be entering a bit of an era again where carry is interesting, but it might be carry balanced against higher volatility across asset classes, which we've also talked about. But in that environment, whether it's EM local currency or EMFX, is interesting, and there will be probably opportunities. So I think those are things that we'll continue to look at. So those are some of the things I think that we're looking at in the portfolio and that we've got on.
Dustin, thanks so much for your time. A little bit longer than normal, but the fact that we got through it in the time that we did, I think, is pretty impressive given everything that's happening. So appreciate your comments, and looking forward to our next conversation.
Thanks very much, Matt. Great to be here. Appreciate it.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.